I started investing right when I got my first job, and ever since then, over the last 6 years, I've made a bunch of mistakes. In total, I think all of these mistakes have cost me over 100,000 ringgit, which is extremely painful to think of, so I kind of just pretend like it never happened. But today, I will relive my past and share with you guys some of the biggest mistakes that I've made with investing so that hopefully you guys can avoid it. The first mistake that I made is a pretty common one. Basically, I didn't save and invest enough of what I earned. So the general benchmark or the general rule of thumb that we're trying to aim for here is to save 15 to 20% of our income and then invest that for the long term. Especially earlier on in my career, I was nowhere close to that. Now, I'm not saying that I should have went to the extent of some of these hardcore financial independence retire early people, or these FIRE movement guys where they say they save 60-70% of their income monthly, because to me that's just not realistic. I don't have any regrets spending some of the money that I did when I was younger on things like holidays and experiences, because these things, we can't really enjoy them, or we don't enjoy them in the same way once we get older. But considering that right from my first job, I already had, I would say, a decent income. I got nice increments and promotions every single year. I got good bonuses, and I even got side income from my businesses. I just didn't invest more money. And I'll be the first to admit that I went through some lifestyle inflation. I was young, I was earning money for the first time. I never saw that much money in my bank account before, so I was spending money on things that didn't really matter to me. I remember I was just going out to eat way too much, and it's not a problem going out to eat, but I was just spending way too much on food, and I was also buying things that were unnecessary. I was doing a lot of impulse shopping, where today I don't even remember where those things are. And the thing about investing is that the more you can invest at an earlier age, the bigger your investment portfolio will be over time. I mean, duh, didn't need Einstein to explain that. But compounding is a very real thing when we're investing our money. Early on, when we have a few hundred ringgit, a few thousand ringgit in our portfolio, maybe we think it's not a big deal, but it can really start to snowball over time. And I would say once you hit that maybe 100,000 ringgit mark, you will really start to see the impacts of compounding for your investments, and the amount of money that you earn from investing every single year could be even more than what you're investing as fresh funds. So after I realized this, I set up some automatic transfers from my bank account straight to my investment platform. So some of my money went to brokers, some of it went to robo-advisors, and then the rest still goes to ASB. Now, every single month, automatic, this happens. I don't have to think about it. And I set up these transfers to happen one day after I receive my salary, so that, receive my salary in my bank account straight away, all my investments are sorted, and I can go ahead, spend the rest however I like. The next mistake that I made was that I mistaked investing for trading. And again, I think this is something that a lot of people go through earlier on in their journeys. So I've always been interested in the stock markets, ever since I was young, and I couldn't wait to get started. For me, as soon as I got my first salary, as soon as I had my own money that I could spend, I'm gonna throw it into the stock markets and start trading or investing, whatever it is. I didn't even know the difference back then. But my overexcitedness kind of caused this mistake to happen. Basically, I didn't want to just, invest in an ETF or invest in some blue chip company like Maybank, be done for a few years, come back in 10, 20 years time and just see how big my investment portfolio was. That's not what I wanted to do. I wanted to be active in the stock markets. I wanted to watch charts every single day. I wanted to buy low, sell high, and then hopefully make a nice profit out of it. Now, there's nothing wrong with this. You can become successful and you can make money by trading stock markets. In fact, that's what I'm doing right now. But we need to know the key differences and not fool ourselves into thinking that we're investing for the long term, when in reality, we're actually trading the stock market. Now, there are some similarities between these two. Obviously, for both of these instances, we are putting our cash in the stock market hoping to make a profit, but that's basically where the similarities end. For trading, it's a lot more short-term in nature. It can be within the same day, it can be a few weeks, or maybe at max a few months. And our transactions are a lot more frequent. We're a lot more active in the stock market. On the other hand, investing is a lot more for the long term. I would say the time span for investing is around a few years or even decades. The thing is, investing is a lot easier than trading, and for the great majority of people, I think they should just stick with investing, and I think that I should have done it earlier in my life as well. But because I wanted to be active in the stock markets, I was trading a lot, I was buying and selling very actively, and I thought it was a good thing. I thought I was making money, and I was. But after a few years, I started to realize that if right from the start, I just dumped all of my money into a single investment, I would actually make more money out of it. So I was trading in and out, buy and sell, buy and sell, buy and sell, making money, and I thought I was good. But if I just bought and held all the way, I would have actually made more money. I only realized this mistake after a few years, and then right after that, I decided to split my portfolios into one trading portfolio and one long-term investment portfolio. So I still enjoy the financial markets, I still want to trade, so that's what I still do. But with just one portfolio, I don't want to make a mistake, with my entire savings, put everything into trading, and then if I mess up, I will actually lose everything. So that's why I have a second account now, and that's purely for long-term investments. I'm not going to be so active in it, just buy ETFs and call it a day. By the way, if any of you guys are looking for a broker to buy both Malaysian and US stocks, then check out Moo Malaysia. They recently got licensed by Securities Commission to operate here, and in my opinion, they have one of the best user interfaces and fee structures among local brokers. They've also got some really handy features for both traders and investors, so check that out and see what works for you. If you guys want to sign up, I'll leave the link down below in the description. They're giving you guys some nice sign up rewards if you just sign up and deposit right now, so make sure you be quick. I also did a YouTube video going through a review of the platform, as well as showing you guys step by step how to make your first investment and how you can make the most out of this new platform. So if you guys want to watch that first, I'll leave the YouTube video link down below as well. Anyway, moving on. The next mistake that I made was that I thought that active investing was easy, and I thought that I was smarter than I actually was. So I started investing back in 2019, and there's two parts to this story. First part, the bear market in 2020 was a gift to me, in hindsight at least. I remember this period very well because I think it was March. Actually, I know it was March because I received my bonus and I had a good chunk of money that I was ready to invest into the stock market. This was the first big amount of money, I would say, that was really good to invest in the stock market, so it was a big deal to me. Back then, because of the bear market, the S&P 500 was down, I think, 30%, which is perfect for someone who's just about to start their investing journey because you get to buy stocks at a discount, and you didn't go through any big drawdown from before this because I didn't have much invested anyway. But I didn't want to invest yet. Then the stock market started to go up a bit, and I thought to myself, there's no way that it's going to go straight up. Obviously, COVID is still a thing, it's still going to drop another 10-20%. That's when I'm going to time the absolute bottom. I'm going to throw in all of my money to invest, and I'll be looked at as a genius in future years. Well, if you guys were investing back then, you would know that the stock markets basically went straight up from there, and by the time that I admitted defeat and decided to invest my money, I bought at prices 15-20% higher than where I should have. I know a lot of people make this mistake as well because, as human beings, we can't tell the future and we don't know where the bear market will end. But that's exactly it. We have to acknowledge that we won't know when the bottom of the stock market will happen, which is why an approach like dollar cost averaging or DCA is a very good approach. Is the stock market up? Yes, I'll invest my money. Is the stock market down? Yes, I'll still invest my money anyway. The second part of the story is from the same period as well. So even though I said, I started investing late, I still made a bunch of money just because the bull market was so strong. I remember back then, I was finding stock picks from random guys on Twitter who I don't even think, to this day, I don't even think that they know what they're saying. But I decided to follow their stock picks, buy it from my own portfolio, and I'll see these stocks go up straight to the moon. I thought I was a genius, and there's no reason for me to invest passively in something like an ETF when I can just actively pick stocks myself and outperform the market. But that's the thing about bull markets. It doesn't matter what you bought if it was very strong, because every single stock will go up anyway. If any of you invested, back in 2020, you would know that if you invested into growth stocks, tech companies, it was basically going up 5, 6, 7% every single day. That's until the bear market came sometime in 2021 or 2022, where tech had a very, very big drawdown, and my whole portfolio had a big drawdown, while an ETF like the S&P 500 was just doing okay because there were other sectors in the ETF that was doing well, like oil and gas. Nowadays, I acknowledge that while it is possible to beat the stock market if you decide to actively invest, it's just going to take a lot of time, and it's not going to be easy. So for me personally, I decided that this is not for me, which is why all of my long-term investments right now are purely in ETFs. Looking back at it, my investment portfolio would actually be a lot larger if I just did this right from the start. And the thing is, I didn't just lose out on money, I didn't just lose out on profits. I also lost out on a lot of time because I had to spend time doing research on these stocks that I wanted to invest in, and the time was just useless basically. If I just left it into an ETF, again, I would just be doing so much better. This next mistake is kind of related to my previous one, which is basically I took on way too much risk. So everyone should know that if you invest your money in the stock markets, it is a risk, there are risks to it, and you can lose money, especially in the short term. So this was perfectly clear to me. I knew the risk that I was taking on. At least I thought I did. So you know how whenever you sign up for a new broker or a new investment platform, they will always do these risk assessments and they will ask you this one question where it basically goes something like, if you were losing money on your portfolio, what would you do? So this to me was simple at the time. I always answered that I would just invest more money. If the stock market was down 50%, if my investments were down 50%, no problem. I would just buy more, it was a discount, and it will eventually go up anyway. In theory at least, I thought that's what I would do. And there's actually no problem with doing this. If you actually did it, you'll be perfectly fine if you did it with an ETF like the S&P 500 for example, or even individual stocks if you're up to date. And whenever there's a discount, you buy it, it goes up over time and you make money. There's no problem with doing this. But what I didn't realize is that when we're thinking about these things in theory, there's no emotions involved. But when it actually happens to your real portfolio and you're down 50%, it's not so easy anymore to just sit there and say you're gonna buy more. Imagine being in your early 20s like I was and seeing your investment portfolio drop by tens of thousands of ringgit in just a few months. That was like nearly my annual salary. How can I afford to lose that? So if you're feeling very anxious or if you're losing sleep at night whenever your portfolio is in the red, then that's an obvious sign that you're taking on too much risk, just like I was. And whenever this happens, there's two main problems that can come up. Number one is you might stop investing or you might stop dollar cost averaging. So this is very common. I always see it in friends. Whenever the stock market is down, they ask me, should I stop dollar cost averaging? This is a really bad thing because the entire purpose of dollar cost averaging is to get a good average price. Sometimes you might buy high, sometimes you'll buy low, and over time your average cost will be somewhere in the middle, which is good enough for us. But the thing is, if you only buy high, whenever the stock market is in a bull market and you're very confident, you keep investing, and then when there's a bear market and everything goes down, you don't want to buy anymore, it means that your average price will be very, very high. So yeah, it's not a good thing to stop investing. The second potential issue that can come up is that there will come a point where you might think to yourself, this is just too much for me, I'm going to cut my losses, I'm going to sell it right now, just to see the investment shoot straight back up right after that. This has happened to me multiple times and I just feel so stupid every time it happens. Now, I'm not saying it's a bad thing to cut your losses, actually it's a good thing, but you don't want to cut your losses just because you took on too much risk. The easy solution is to just be honest with yourself. Now that I say that, I guess it's not so easy, right? But one potential solution that I've come up with is that, especially for people who are just starting out their investment journeys, you will want to be a lot more risk averse. So let's say at the start, you want to take a very low risk investment like amanah saham, fixed deposits, or even money market funds. These are investments that you can't really lose money from because their values are fixed. And then once you've got a hang of that, once you understand how these returns work, then you can move on to a bit more risky stuff. You can move on to like bonds or even blue chip companies where their values are quite stable. So you go through this, you go through a bear market, you know what it feels like whenever your portfolio drops in value. Once you've gotten comfortable with that, and then you can move on to higher risk stuff like, for example, investing in tech companies or investing in very high growth companies. So yeah, just don't rush into it because eventually you might regret it just like I did. So as I grew older and I got more experience, I realized that my risk tolerance now is a lot higher than what it used to be. It's actually at a level where I thought it was back then when I was just starting out. But yeah, right now I don't get so anxious anymore whenever there's a bear market, whenever my portfolio drops down big in value. But the bull market, earlier on in my investing journey, it made me way too confident. Every single stock that I bought back then was just going up every single day. I thought it was easy. I didn't even think about what would happen if a bear market came and everything dropped by 50%. And then it eventually came, I panicked, I sold my investments, and I lost quite a bit of money. So the key takeaway here is that the best investment you can take is always the one that you can stick to. So manage your risk first, and then your returns will come later. Finally, the last major mistake that I made with my investing is that I didn't take profits. This happened once in 2021 with stocks and then another time in 2022 with crypto. Making a mistake once is normal, everyone makes mistakes. But making it twice, I just don't know what I was doing. And this one probably cost me the most. I would say over 100,000 ringgit alone just from this I gave up in terms of profits. But I have to say, this one is a bit tricky to find a solution for. So even though yes, I do say you don't want to be greedy, you want to take in your profits, on the other hand, we also don't want to rush to take our profits so much. So let's say we invest into something like the S&P 500 and then it goes up 1% in a day. We don't want to sell this investment now, be happy with your 1%, because if we do that, we will never be able to leverage compound returns. So I have one general rule of thumb that I have right now for my portfolio is that for all of my ETFs, I won't be touching it, I won't be selling it at any time unless something really crazy happens, like it goes up 500% in 1 year, which will probably never happen. And on the other hand, I have my individual stocks and my crypto. For this side of my portfolio, I'll be actively watching it, and whenever I think it's time for me to take profits on a green day, I will decide to sell it. Just remember this, nothing goes up in a straight line forever. There will always be pullbacks, and generally, the more crazy the up move is, the more likely that the move down will be equally as crazy, except this time, it won't be so good for your portfolio. Look at companies like Zoom and C Limited from 2021, and you can look at crypto as well. Zoom, for example, it went up 800% in just a year. This is abnormal. It doesn't happen every year. Otherwise, all of us would be millionaires, So if you hold any investment that is up this much in a short amount of time, it makes this kind of crazy move, first of all, congrats. But second of all, maybe it's time for you to think about when you want to sell and lock in your profits. Maybe, after you sell, it continues to go up. But if you've already made 500% in 6 months, then who cares? I know that, trying to time the top of the market, trying to know when is the perfect time to sell is just as impossible as, trying to time the bottom of the market for us to buy. So aside from looking at how crazy the move is, I also have some other rules that help me decide if it's time to take profits. For one, if your 70-year-old grandmother is starting to ask you if that particular stock or crypto is a good investment, then maybe it's time to sell. This number 2 rule has been really good for me. So whenever I feel like, taking a screenshot of my unrealized profits and sharing it to my friends or sharing it on social media to brag, then it's probably time for me to sell and take a profit as well. Some people will say that, you need to have diamond hands, you need to hold on to these investments so that you can become a millionaire by the time you're 30. The thing is, you only hear the good stories. You only hear the successful people who have done this. You don't hear the way bigger amount of people who tried doing this and then gave up all of their profits only to break even, or even worse, lose money on that investment. So there has to be a point where, if you've already made so much money in a short period of time from a particular investment, it's time for you to think, to sit down and really think, is this enough for me? And, should I just lock it in right now with what I already have? Selling an investment and seeing it go up more in value hurts, I know. But holding on to a big profitable investment and then seeing it come back all the way down, it hurts even more. Trust me, I've gone through both of those multiple times. I'll just share with you guys an example. This is a personal example, but crypto was my most painful experience with this. Just imagine at the time I had a really big portfolio from trading crypto, NFTs and stuff like that, and just one NFT in my portfolio. It was the biggest NFT that I owned, obviously, but it was big enough that if I sold that, it could pay off my entire car loan. But I didn't sell, at the time. I decided to hold on to it, and the value just came crashing back down. I'm not so fussed about it. That's why I'm willing to share this with you guys. I know I'm young. I know I can make this money back. But I just hope that, sharing these experiences, it will help you realize, especially in these times where, again, crypto is making a really, really big run. So I hope you guys learned something from this video, and I hope that, you guys can go through some of these mistakes and hopefully avoid them in the future, because they can be quite painful. Investing is actually pretty easy. We just decide to make it harder for ourselves. Anyway, thanks for watching this video to the end. Give us a huge thumbs up if you enjoyed it and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.